Samsung earns about $8,000 a second. In the 20 seconds you spent reading this, it made over $160,000. And it's still counting. Last quarter, it out-earned every company on Earth, even Nvidia, and yet, its stock is one of the wildest casino rides in the market. Earning this much? So why? So, is Samsung stock a buy? On July 7th, Samsung reported operating profit of $89.4 trillion to $1 for the second quarter, roughly $65 billion. That is not just a good number. Over 3 months, Samsung earned more than any private company on the planet, more than Nvidia. But on the day it posted the best earnings in its history, the stock fell 7% and 9% at one point during the day. Best earnings ever, and the stock drops 9%. Does that make sense? It does. And understanding this one sentence is the whole point. Here is the hint. Memory chips are cyclical, a boom and bust industry, and Samsung rides that cycle in a way that is completely different from its rivals. 89 trillion won is hard to picture, so let's break it down. Spread it across one quarter, 90 days, and that is about 1 trillion won a day. Break it down to the second, and it is the number from the opening, roughly $8,000 every second. But here is the part that is genuinely staggering. Look at Samsung's operating profit over the last 3 years. 2023, 6.6 trillion to won. 2024, 32.7. 2025, 43.6. Add all 3 years together, and you get 82.8 trillion won. And then, in a single quarter of 2026, Samsung earned 89.4, more than the previous 3 years combined, and that 89 trillion already has 19 to 20 trillion won carved out for employee bonuses. Without that, one quarter clears 100 trillion. So the scale is real. There is no doubt about it. And that precisely is the trap. To understand why record earnings send the stock down, you first have to understand what kind of market memory is. Let me give you an American analogy. Beef. When beef prices spike, ranchers make a fortune. Everyone who sees it rushes to raise more cattle. A few years later, beef floods the market, prices crash, and everyone suffers. The struggling ranchers stop raising cattle, so a few years after that, beef gets scarce again, and prices spike again. Round and round. It is in the economics textbooks. They call it the cattle cycle. Memory chips are exactly this. We call it cyclical. Just think of it as a roller coaster industry. And right now, prices are soaring. According to research firm TrendForce, DRAM prices rose 90 to 95% in the first quarter versus the quarter before, and another 58 to 63% in the second. Multiply those, and prices roughly tripled in half a year. You have heard people say computer memory prices have gone insane? This is why. Now here is the key. The stock market does not care how much a company earns today. It cares whether it will earn more or less tomorrow. That one sentence is the whole game. Here is the decisive data. Take those DRAM price increases and put them in order. First quarter, 90 to 95%. Second quarter, 58 to 63. And the third quarter forecast, 13 to 18%. That is from TrendForce as well, 90 to 58 to 13. Do not misread this. Prices are not falling, they are still rising. It is the speed of the increase that is slowing down. Think of a car. You are accelerating at 90, then 58, then 13. The car is still getting faster, but the driver knows, any moment now, the brakes are coming, and the stock market hits those brakes 6 months to a year early. That is why earnings can be at an all-time high while the stock falls first. The slowdown has already begun, and that is not a forecast. It is a confirmed number. Is this the first time? No. The exact same thing happened in 2018. Back then, Samsung and SK Hynix were shattering earnings records, quarter after quarter, in the middle of a memory supercycle. But the stock had already turned months earlier and started falling, while earnings were still breaking records. It ended down about 40% from the top. The news was firing off celebrations about record profits, while the brokerage screens looked like a funeral. Why does this happen? Because as we just saw, the stock does not buy earnings, it buys the direction of earnings. The moment the slowdown in price gains gets confirmed, the stock turns ahead of time. And the movie from 2018 may be playing again right now. Now here is where Samsung is fundamentally different from SK Hynix. Understand just this, and you have gotten your money's worth. SK Hynix only sells beef. It is a pure ranch. So when beef prices rise, it is simply good news. Full stop. But Samsung sells beef and also runs a burger chain that cooks with that same beef. The company is two halves. The side that makes chips, that is the ranch, and the side that makes Galaxy phones, TVs, and refrigerators, that is the burger chain. When beef prices spike, the ranch is swimming in money, but the burger chain inside the same company, it gets hit with a cost bomb. Galaxy phones need memory. So do the TVs, so do the fridges. Samsung is buying the very chips it marked up, with its own phone division. And this is not my guess. It is written in Samsung's own filings that the phone and appliance divisions face, quote, rising cost burdens and limited room for improvement because of higher costs. So the conclusion is this. On the way up, the pure ranch, Hynix, rises harder. On the way down, when beef prices fall, the burger chain smiles, so Samsung falls less. For the last 2 years, Hynix stock flew while Samsung crawled, and this structure is exactly why. Integration is a shield in a downturn, but a ball and chain in a boom. But surely Samsung, the #1 chip maker, is winning everywhere? Only half true. In the overall DRAM market, Samsung is indeed #1, with an estimated 38% share. But the priciest, most profitable product today is HBM. If regular memory is a single-story house, HBM is that house stacked into a high-rise. Far faster, far more expensive. It is what AI computation needs, and it is what goes into Nvidia's graphics cards. Now look at the HBM market share. SK Hynix holds well over half, while Samsung and Micron each sit around 20%. Estimates vary by research firm, but the direction is the same. In the juiciest market of all, Samsung is roughly a third of the leader. There is a comeback card. This year, Samsung became the first in the world to mass produce the next generation HBM4 ahead of Hynix. But here is the cold truth. The question is not whether Samsung wins HBM. It is what is already priced into the stock. For years, Samsung has traded at a discount, wearing the label of the perpetual #2 in HBM. If that label comes off, the stock can jump. But for now, it is still #2. Samsung does hold one card that Hynix does not, foundry. What is a foundry? It is a factory that makes other companies' chips for them. When Apple or Tesla design a chip and say, build this for us, the foundry builds it. Think of it as contract manufacturing. This market is dominated by Taiwan's TSMC, with Samsung stuck in single-digit share. It was, frankly, a failing business. Years of losses running into the trillions. But this year, the picture is changing. Tesla handed Samsung the AI chip for its self-driving cars, and the fab Samsung built in Texas has started running. Reports put that deal alone in the 20 trillion won range. So the industry is now talking about foundry turning a profit as soon as this year, and Samsung has pulled its break-even target forward from 2027 to 2026. Why does that matter? 2 reasons. First, plugging a hole that leaked trillions every year lifts profit on its own. Second, and this is the big one, memory is a roller coaster, but foundry is far less so. If Samsung establishes itself in foundry, the roller coaster label could come off entirely. But be clear-eyed here. This is still an outlook. It has not turned a profit. It looks like it might. It is the bull case's strongest card, and it is not yet proven. Now to the point where a lot of people get fooled. The PE ratio. First, the basics. It is simply the number of years of earnings you are paying for at today's price. A PE of 10 means you are paying 10 years of profit. Lower usually looks cheaper. But here is the trap. Remember just this one line today. For a roller coaster stock, the PE is most dangerous when it is at its lowest. Why? Think about it. Why does a PE fall? Because earnings are at a record high. And record earnings mean you are near the top of the roller coaster. What comes next is an earnings decline. And the stock. knowing that in advance falls first. Flip it around. When is the PE 100 or so high, it cannot even be calculated because of losses at the bottom of earnings, and that is the actual bottom. So a cyclical is read the opposite way from a normal stock. You buy when the PE is high and sell when it is low. Miss this. Walk in saying Samsung's PE is in single digits, it is a steal, and you will grab the exact top. So where is the stock right now? As of the July 23rd close, about 268,001. A year ago, the low was in the 60,001 range, so it is up more than fourfold in a year. Then in mid-June, it hit an intraday high of 374,501, and it has fallen almost 30% in a month to get here, up fourfold in a year, down 30% in a month. That is Samsung. If you thought of it as a safe national blue chip, change your thinking. This is not a savings account. It is one of the most violently swinging large caps on the planet. 3 risks, briefly. 1. China is catching up. A Chinese firm called CXMT saw its DRAM share jump from 3% to nearly 8% in a single year. It cannot make HBM yet, but it is pushing into regular memory at prices 30% cheaper. And remember the analogy, Samsung is heavy in regular memory, Hynix is heavy in HBM. So China's price war hits Samsung harder. 2. Shareholders do not get to keep all the profit. This year, the union demanded a large slice of operating profit as bonuses, and 19 to 20 trillion won was carved out in the second quarter alone. Meanwhile, the dividend has been fixed at 9.8 trillion won a year, which at today's price is a yield of about 0.6%, worse than a bank deposit. 3. The 2028 cliff. China floods the market, the factories being built now all switch on around 2028, and AI investment stumbles even once. Then beef floods the market. Keep in mind, Samsung's chip division posted losses in the trillions in 2023, just 3 years ago. So, buy or not? There are 3 scenarios, and there is no single answer. But today, I will put the weight on why caution is warranted. First, the bull view. It is still only halftime. Brokerages see next year as even better than this one. And out of 36 analysts, not a single one has a sell rating. Target prices have climbed to between 550 and 590,000 won. If foundry turns profitable and HBM share recovers, Samsung graduates from roller coaster company to AI infrastructure company. Second, the bear view. Earnings are great, but the stock turns first. It is the 2018 rerun. The DRAM price increase cooling from 90% to 13% is already fact. In this scenario, today's 268,000 is not the bottom. It is a ledge on the way down. Third, the 2028 cliff, where those 3 risks collide. And here is what you must not skip. Not a single sell rating, targets near 600,000. That rosy consensus looked exactly the same in 2018, and then the stock fell 40%. So the real question is not whether Samsung is a good company. It is a good company. The real question is where on this roller coaster you are sitting right now. So what do you actually watch? One thing, let me give you a date. July 30th, 10 a.m. That is when Samsung reports its confirmed second quarter results. The 89 trillion so far is a rough preliminary figure. This is when the breakdown by division shows up for the first time. Watch 3 things. 1, how much the foundry loss shrank. That tells you whether the turnaround is real. 2, the tone management takes on HBM. 3, whether they talk about second half prices with confidence or with caution. Watch the tone more than the numbers. 89 trillion is already the known past, and the market does not buy what it already knows. To sum up, ignore a company earning 3 years of profit in 3 months and you will feel foolish. But buy it after a 4-fold run and a 30% drop from the top, and you are buying near the peak. The top of a roller coaster always looks exactly like this. Whether it is the peak or just a ledge, you only know after the fact. So anyone speaking with total certainty right now, bull or bear, is worth a second look. This is analysis based on public filings and news, not a recommendation to buy or sell. Your decisions and their consequences are your own, not financial advice.